This is ShadowQuant Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Tuesday, July 7, 2026, and this is the New York pre-market. Now, let's get into it. The S&P 500 is clinging to $751.28, but don't let the green close fool you. This is a rally built on a single pillar: technology. As we look at the pre-market, we are seeing a violent divergence emerge, one where the engines of future growth are suddenly stalling, while the broader market pretends everything is fine. Before the bell rings, here is what is on the schedule for Tuesday, July 7th, and Wednesday, July 8th. Tomorrow, July 8th, brings earnings from AZZ, reporting estimates of $1.63 per share, and BSET, expecting $0.20. HEAL also reports, though estimates are not available. On Thursday, July 9th, Delta Airlines is the standout with an estimated $1.49 earnings per share. That is the core of the near-term catalysts.
The delta here isn't just the earnings prints, it's the volume. With Riven and WDC already gapping down in pre-market, any earnings miss from DAL or Artwa could act as the spark that turns this narrow tech rally into a broader sector flush. Watch for liquidity traps in those lower volume names.
Let's set the board. As of 16:34 ET today, SPY is at $751.28, up 0.87%. Triple Q is stronger at $722.82, up 1.43%. But look closer. IWM is barely moving at $298.90, up just 0.44%. Diamonds is flat at $530.09. The story right now is bifurcation. The technology sector is the clear leader at $183.57, up 1.65%, while defensive sectors like the utilities sector and consumer staples are bleeding. And in the background, the VIX is suppressed at 15.81. Grid, walk us through what these numbers are telling us about the structure of this move. Three massive headlines are dominating the pre-market tape. First, the semiconductor equipment complex is getting hammered. LRCX is down 6.6%, AMAT is down 6.5%, and CLAC is down 6.1%. Second, Rivian is taking a massive hit, dropping 11.3% following a 75 million share equity offering. Third, we are seeing a stark contrast in momentum. The financial sector is up 0.93% today and nearly 5% for the week, while the energy sector is down 0.17%. Pulse, this feels like a classic risk-on rotation gone narrow. How is the sentiment actually reflecting this? It's not reflection, it's denial. Look at the news sentiment scores. MSFT is bullish at +0.39. Meta is bullish at +0.33. But NVDA, neutral to negative at -0.15 across 60 articles. MU is even worse at -0.19. The retail crowd and algorithmic flow are still chasing the headline names because they're up, but the actual narrative sentiment around the infrastructure builders is souring. The disconnect between price and perception is the danger zone.
And that disconnect is funded by leverage. You have the VIX at 1581. That is a complacency reading. When you combine suppressed volatility with a 6% crash in semiconductor equipment, you aren't seeing healthy profit-taking. You are seeing a liquidity vacuum forming in the very sector propping up the triple Q. The market is pricing in a soft landing, while the hardware guys are screaming about CAPEX slowdowns.
Let's dig into that tension. We have the technology sector leading the index at $183.57, up 1.65%, yet the actual machinery companies, LRCX, AMAT, CLAC, are all down over 6%. This is the backbone of the AI narrative. CIPHER, where is the money actually going in this space?
It's fleeing the supply chain. The price action in the technology sector is being carried by pure software and cloud names, while the capital expenditure heavyweights are facing unwinding positions. LRCX at -6.6% isn't just a dip, it's an institutional exit signal. If the equipment makers can't justify their multiples, the entire tier-up valuation model breaks. We are seeing heavy distribution in these names, not accumulation.
Let's look at the mechanics of that distribution. SPY is sitting at $751.28, practically kissing its 10-day high of $752.41. But look at the triple Q structure. $722.82 is approaching resistance at $726.08 from yesterday's high, and above that, $730.83 from July 2nd. What's happening underneath is that support at $719.93, the opening price from July 6th, is becoming a floor that is losing thickness. If LRCX and AMAT continue to bleed, Triple Q doesn't have the technical depth to hold $726. It's running on fumes.
Exactly. And here is the risk no one wants to admit. The VIX at 15.81 is hiding the fact that implied volatility in these option names is spiking precisely because of this earnings uncertainty and the pre-market gaps. You have a situation where the index looks strong, but the components are cracking. When the technology sector tries to push above $185, it will hit a wall of option sellers looking to hedge this exact scenario. The bull case relies on the technology sector continuing to decouple from its own constituents.
And the crowd isn't even noticing the crack yet. They see the technology sector green and think AI trade is safe. But the sentiment on the actual manufacturers is turning. Once the narrative shifts from growth is infinite to capex is saturated, the velocity of selling accelerates. We are standing on the edge of a sentiment flip for the entire hardware sector. So, is the SPY rise sustainable if the engines are failing?
Not sustainably. The earnings flow data shows institutions rotating out of the high-beta hardware plays and into the cash flow positive software giants. It's a defensive maneuver disguised as offensive growth. They are selling LRCX to buy Microsoft. That keeps SPY green but strips the market of its volatility and therefore its future alpha.
That brings us to the other side of the coin, small caps. IWM is at $298.90, up a mere 0.44%, while SPY is up 0.87%. Grid, look at that $300 level.
IWM failed to hold $300. Its 10-day high was $302.72, and it couldn't even reclaim $300.41 from yesterday. Support is clearly defined at $297.62, which is essentially where it opened yesterday at $297.75. The chart is telling us that every time it touches $300, sellers step in. There is zero momentum here. Meanwhile, SPY is grinding higher. This is a textbook divergence of strength. The Russell 2000 is technically stuck in a consolidation box between $297.62 and $300.41, and it is choosing down.
And that is the canary in the coal mine. Small caps are interest rate sensitive. With the 10-year, 2-year yield curve flat at plus 0.35 and inflation at 4.17%, borrowing costs remain a stranglehold on smaller businesses. The fact that IWM is lagging SPY by more than double indicates that smart money is abandoning speculative growth in favor of established large-cap moats. This isn't just a tech issue, it's a credit quality issue.
The sentiment data confirms it. Consumer discretionary, which feeds into small-cap performance, is mixed. Consumer discretionary is up 0.76%, but you have Rivian down 11.3% on dilution. That kind of volatility kills confidence in the broader EV and retail ecosystem. Retail investors are hesitant to chase small caps when the big players are cutting them off with stock splits and dilutive offerings. The wealth effect is confined strictly to the Fortune 100. Yet one sector is bucking the trend: financials. The financial sector is up 0.93% today and gaining nearly 5% for the week. Why are banks winning while tech equipment makers lose?
It's the yield curve play. Even though the curve is flat, the financial sector benefits from net interest margin expectations and fee generation in a volatile environment. Plus, look at the relative strength. Money is flowing from the speculative tech hardware into the regulated financials. It's a flight to quality within the risk-on trade. The financial sector is accumulating volume here, whereas the technology sector is distributing.
which creates a fascinating dynamic for the overall market structure. Grid flagged the SPY resistance at $752.41, but CIPHER shows that the money isn't staying in the index. It's migrating laterally into financials and communication services. Communication services up 0.56%. The rally isn't broadening, it's shifting lanes. So if tech stumbles, financials might catch the overflow, but only if the macro backdrop doesn't turn hostile.
Don't bet on that overflow being permanent. The financial sector is up 0.93%, sure, but look at the broader macro constraint. Core PCE is 3.41%. The Fed funds rate is 3.63%. If inflation proves stickier than expected, which the data strongly suggests, financials will face loan loss provisions and reduced deal flow. The current strength in the financial sector is a reaction to the fear of tech weakness, not necessarily faith in economic robustness. It's a defensive hedge wearing a suit.
Speaking of fear, let's address the elephant in the room. Rivian, down 11.3% on a 75 million share offering. Ripple effects here. Total contagion risk. You have an 11.3% gap in one EV maker. That drags down the sentiment for the entire consumer discretionary sector. Consumer discretionary is up 0.76%, but that gain is entirely artificial now, propped up by non-EV names like Amazon or Netflix potentially offsetting the drag from auto. Once traders realize how much weight Rivian has in certain indices, the short-term rebalancing could accelerate the sell-off.
The positioning is ugly. A 75 million share sale raises about $1.50 billion, but it floods the float. Institutional owners are forced to mark down their models. This isn't a temporary blip. It's a structural repricing of EV margins. If Rivian can't prove it can grow without constant dilution, the entire sector gets tagged with a capital-intensive trap label. That hurts Tesla, Lucid, and legacy auto EV divisions alike.
Technically, look at the Triple Q. Triple Q is at $722.82. Rivian is a component. While its weight isn't enough to single-handedly drag the index, it contributes to the noise. However, the bigger picture is that volatility in EV names makes the whole sector harder to trade. Traders are avoiding EV-related ETFs and holdings until this dilution event settles. That reduces liquidity in the sector, making any subsequent rebounds slower and less reliable.
Let's tie this together. We have a market at $751.28, seemingly strong but internally fractured. Apex, give us the final read.
Here is the synthesis. Grid correctly identified the technical ceiling at $752.41 for SPY and the stagnation of IWM at $298.90. CIPHER backed that up by showing the capital migration away from semiconductor equipment, LRCX, AMAT, and into financials, the financial sector and software. SPECTER warned us that the VIX at 15.81 is masking a credit quality deterioration. And Pulse confirmed that sentiment on key AI infrastructure names is turning negative despite price strength. The verdict: the market is not in a healthy bull phase, it is in a concentration risk phase. The upside is capped by the failure of IWM and the semiconductor supply chain, while the downside risk is amplified by the lack of breadth. We are watching a pivot point, not a continuation.
Key takeaways for your desk tonight. 1. SPY is testing resistance at $752.41 with diminishing breadth. 2. Semiconductor equipment names are undergoing a structural sell-off that threatens Triple Q stability. 3. Small caps, IWM, are failing to hold $300, signaling a lack of broad economic participation. Keep your eyes on the yield curve and the VIX for signs of the complacency breaking. Thank you for listening to the ShadowQuant Equities Edition. See you tomorrow. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Equities. Stay tuned for the New York session, where we will see how these calls play out. Until then, trade safe.